On October 8th, 2020, Jonathan Twomley and I turned a $117 million multifamily property into a $60 million property. Folks, if you're not doing the math quickly, that is roughly a 50% drop. That is also means all limited partners are gone. That means the bank is taking haircuts, all kinds of nastiness. But today is May 15th, 2025. And I think it's about time to tell you what is coming on the other side of this pain. Jonathan, you and I were early. You and I were right. You and I saw the crazy deals being done with bad debt, short term, all this stuff. We were right about the colossal collapse. But now it's time for us to be right again on the other side. What do you see coming over the next couple of years as these deals take massive haircuts?
Yeah, what I see is if you are a buyer and you have access to cash, you are going to have the best buying opportunity that anyone has seen since the great financial crisis. This is basically, these are the kind of things that if you're a real estate investor, they come along 2-3 times in your lifetime.
Correct.
And you have to take advantage if you're in the position to do so. So what we're going to see now, I think a lot of people feel that the hit has already been taken, and definitely a hit has been taken. We have seen multifamily values drop by about 25 to 30%. I have not been actively buying multifamily myself yet. I've been still focused on the hotels. But when I'm talking to my friends who are buying multifamily, what they're telling me is that the market is thin. It's hard to find deals, but the deals that are trading, deals that were trading for $220 a door a couple of years ago, trading for $150, $160 right now. So I had a good conversation with a friend of mine, Chris Jackson, the other day, who's actually a member of my coaching community. He's got about 1,500 doors. He was telling me that he is actually starting to see some apartment buildings that he's buying that are actually meeting the 1% rule, which is pretty remarkable. So, and I seem to have lost you, Michael. You've frozen up.
You're really protecting the downside, which is the real key to all of this. So if you can protect the downside, again, if you're buying a building for 80 million that was 160, it means you're getting debt at like 55 or 60. It's a very secure position. And all you got to do is wait for it to come back. Will it go back to 160? Who knows, but it'll go back to 120 for sure.
So Michael, I don't know what just happened. We had a glitch where I was talking and you were talking.
I could hear you, so we're going to keep rolling. So.
Okay. All right, cool. So we'll just edit it out. I couldn't see anymore. So, but anyway, I was talking about my friend, Chris Jackson, who is buying properties that meet the 1% rule, and which really hasn't happened in multifamily for a very long time.
Oh yeah.
So, if you're meeting the 1% rule, it means that you're cash flowing right away. And that's really where you want to be. I mean, that's always where I wanted to be in multifamily, was cash flowing right away. And it wasn't possible for a very long time because prices got to be so outrageous, right? So we're starting to see the cracks. We're starting to see this happening. But as somewhere, in this conversation, and I know this will get all edited and super smooth and everything because that little tech glitch we had. But where I was going with this is that we have seen a hit, right? We have seen a hit taken, but the other shoe is yet to drop. There's going to be more of a hit. This isn't like a drop and then a V-shaped recovery, or a drop and even like a U-shaped recovery. This is a drop and another drop. And we're waiting for the second drop to happen. The reason that this is going on right now is because of extend and pretend.
Correct.
Right? And so, the last time around, all the lenders foreclosed right away. They drove the market down very sharply, very fast. They sort of learned their lesson from that and haven't been pushing foreclosures or forced sales. They've been extending and pretending. The problem is they're all doing it on the same schedule because all the debt was issued at the same time in 2021, 2022. And so it's all going to kind of hit at the same time anyway, just delayed. But if you're ready for that to happen, then, you know, you're going to be able to buy some really good bargains for property.
Yeah. Yeah. When I'm telling people in my world, and again, let me know if you think this is right. When you talk about that second shoe to drop, this is how I see it. I see Class A, like Class A plus retrading. This is the stuff that Ken McElroy, you know, Grant Cardone, you know, they're going after. That stuff's starting to retrade. And like you said, at a 20 or 25% discount. I mean, Ken has talked about several deals. One that he bought with 5 miles of my house here in Henderson, Nevada. And that stuff's retrading. But what's not retrading is Class B and Class C. That's where a lot of us are playing. And again, like we talked about in 2020, October 8th, I was seeing deals in my buy box that should be an 8.5 cap that were trading at sub 5. That's stupid.
So here is what's going on with the Class B and C. Okay. Now, normally, and I think I've talked about this on the channel before, you can think about like your Class A, B, and C property and your Class A, B, and C markets and put it into a 9-box grid where you have in the upper left, you have an A property and an A market, and the lower right, you have a C property and a C market, right? And there should be a good cap rate spread between each of those boxes as you go down the quality range, right? So where you get to, you know, so if you've got like an A deal and an A market, you know, that should be, you know, historically that would be trading at about like a 5 cap, right? And then B is 6 and C is 7 in your top market, right? But then as you go down CCC, you would go, so C in an A market is a 7, C in a B market is an 8, C in a C market is a 9. Right. And these are rough guides, right? But that's accounting for the risk premium that you pay, that a buyer wants to have to buy a lower quality property. Right. Now, what happened when money was so cheap was that whole thing compressed to the point that there was barely any cap rate spread between like a Class A and an A market and a Class C and a C market. What's happening now is the A stuff is still trading, right? But the B and C stuff is not trading because there's still no risk premium there. And there's going to be some serious pain. There just has to be, like, there's going to be pain as that trade unwinds, right? And because people are not, so right now, one of the things that you know we've been talking about with folks in the business is that, like, nobody wants to touch this like 1970s product anymore, right? And increasingly 1980s, and this will not last forever. But the problem is the reason nobody wants to touch it now is not because, like, you know, you're going to walk up to it and turn the key and the thing is going to collapse, right? That's not the reason. The reason is because the risk premium is not there to account for the fact that C property has got lower quality tenants, it's got more deferred maintenance, it's just going to have more stuff going wrong. And you need that extra cap rate cushion in order to essentially generate the same yields as the same profits that you're going to get on
risk adjusted return
on that Class A, right?
Yeah,
so
exactly, yeah.
So it's just going to take time and foreclosures, unfortunately.
Oh yeah, for sure.
For that risk premium to come back into the market, right? And you'll see, and actually the way things work, and you and I have talked about this before, you may even see the pendulum swing past it, right?
Yes,
so that
regression to the mean is going to be painful,
right? Which, you know, it doesn't stop at the mean; it keeps going, and then it hits the nadir and it starts going back to the mean. But so you might be able to get those Class C deals for a 10 cap, 11 cap, right?
Exactly. That's what I see coming. Exactly. And again, what I think is really interesting about this conversation on May 15th, 2025 is when I think about our conversation October 8th of 2020, we were years ahead of the market, but it was plain as day that this was coming, right? At the end of the day, multifamily investing is a math formula. And if you're going to make stupid assumptions with bad short-term debt, you're going to get hurt. When you swing the other way, you're buying it better. You're getting lower leverage. You're getting longer term debt. Your chances of winning are wonderful. But I think we're both saying this is not happening tomorrow, but it will happen. And we just want people to be ready.
It's going to happen in the next 2 years, though, because what's going to happen is that debt, those extensions are going to run out. It's starting to happen already, right? The lenders are starting to say, enough is enough. We're done. We're just going to take a haircut, get what we can back, and move on with our lives. Yep. And so that is going to be increasingly happening over the next 2 years as those extensions that run out. And so there is kind of a timeline for this. This is not like, oh, it's going to happen someday. I mean, this is going to happen by 2027 because, that's 5 years from 2022, which is when either 5-year debt terms are ending or 3+1+1 bridge loans are ending that we're all at the top of the market. And the capital is not there to refinance those loans at anything near the original principal, right? So
you couldn't refi them for the debt.
Well, that's what I'm saying. I'm saying you will not be able, so they will not, at best, those are going to be cash in refis at best. Right. And more likely a lot of them are just going to be foreclosures or short sales or what have you. Right. Yeah. And so that's what you should be getting ready for. And, where the money's going to be made. And then the cycle will start again. Right. But we've just seen this kind of drag out. And I don't even want to say it's dragging out more slowly because actually the bottom of the GFC for multifamily is 2013. The market didn't actually bottom for 5 years. This is probably the same reason because everybody had 5-year debt and they could kind of they were able to kind of string it along for 5 years until they couldn't refinance.
I love that you brought that up because again, when I look back at our history and I write about this in my book, One Rental at a Time, we were buying houses for 50 cents on the dollar, starting in 2009. We didn't buy our multifamily foreclosures until 12 and 13. You're absolutely right. The owners can hold on longer. There's a bigger number, so the banks are probably more interested in working with you. The banks on the multifamily were smaller and more local banks, as opposed to everything was sold off to Fannie and Freddie or whatever. So again, you're absolutely right. But this is coming. I'm looking all the time. I'm talking to more and more brokers in my market because I know this is coming. They know it's coming. It's 26 or 27, I think, is when this happens.
Yeah, because there's the 21 era debt and the 22 era debt.
Correct.
Right? And then 23 drops off the table. Deals weren't getting done, right? But it's correct. 22 was the peak, and 20. We're still not. I mean, stuff is priced like 2018, 2019 prices as it is right now, right? So there's still a way to go. But this is what's coming, guys. So get ready.
Yeah. Any kind of closing thoughts, or maybe, maybe I don't know what you're doing Sunday mornings, but I run a school community. So it'd be 11 o'clock your time. I don't know if you're free on Sundays, but maybe would you be game to come inside our school community?
Oh yeah, absolutely.
Not this Sunday, but maybe next Sunday, and we can talk about this.
Yeah. Just ping me sometime, and just let me know. I'm usually available on a Sunday. So would love to do that. But I do have sort of one more thought that I wanted to talk a little bit about. So, if we go back to, if we cast our minds back to 2020, right? And even 2019, when you and I were talking about this, like when I sold off my major portfolio, right?
Me too. I sold off a bunch.
And got a lot of criticism at that time for trying to quote unquote time the market.
Yeah.
Right. You're trying to time the market, which is so silly because everybody who accused me of trying to time the market was actually trying to time the market by holding on longer, right?
Exactly.
Until like the absolute peak, right?
Yeah.
It was very silly, but it does raise a good. I agree that you can only call the top in hindsight. This is true.
Correct.
Right. However,
sure.
So people then will say, well, if you can only call the top in hindsight, then you can't judge anything. You can't make any decisions about where you are in the market cycle. So therefore you just have to keep buying, right?
Not true. Not true.
Right?
Not true.
So I wanted to talk a little bit about what are the signals that you are nearing the top, right? Because you never know exactly when the top is, but you can start to get an idea that
you want to know what my number one is?
What?
when I go to speak at conferences or real estate meetups as the boring single family one rental at a time guy, and no one wants to hear my story. They all want to talk to syndicators and that not only syndicators, but syndicators who have never done a deal, never owned anything, and are buying out of state with no track record. That's when I know the craziness is coming.
Okay, that's certainly one sign, right? But that's like a soft data point, right?
True.
As opposed to like a hard data point. And I was thinking about, well, what are like the hard data points
cap rate compression
that you could look at? Yeah, so cap rate compression is definitely one of them. But I think even more than that. Well, actually, I'm gonna ask you to guess what you think I'm gonna say. So what do you think I'm gonna say?
So I would see cap rate compression one, and then second, I'm gonna go with banks. Banks getting looser on lending as the next one.
Close, yeah, very, very close. It is in the debt realm. So what I'm gonna say is when you see the banks. So the first step is you see the banks starting to get not just looser, but they start
creating product.
Yeah. Like changing their terms. So you start seeing stuff like lots of interest only, right? Where they first it started off, we saw it in the last like a 1 year. And everyone was like, oh, you can get a year of interest only. Eventually I was hearing about people getting 5 years of interest only.
Sure.
Right, on debt, right? So when you see banks start to loosen their standards, and it's been going on for a while, right? Once it starts, like the clock is ticking to the top of the market, because the banks are doing that for two reasons. One, they can't compete anymore unless they loosen their standards. And two, like they've bought into the idea that this is going up forever, right? They feel safe doing this, and that's a bad sign. Now, when you really know you're getting towards the top is when the banks start getting priced out and people are doing deals with bridge debt, right, instead of permanent debt. Like when they start when you start seeing people do creative financing or financial engineering, right? They start doing so in the great financial crisis when the 75% leverage from a bank could not get you to the returns to equity that your LPs were demanding. Well, you went and you got 7 or 8 points of mezz debt and you stuck it behind your, or sometimes even more, right? I remember people talk. I remember when I first got into the business, some guy told me I can get you 93% leverage. And I was like, why on earth would I want 93% leverage on anything? Right.
That's crazy.
Right. But so mezz debt was the way they did it before. Then after the GFC, the banks were like, okay, no more mezz. You can't put any more debt on this. So what happened? Pref equity, right?
Yep.
Pref equity was the new mezz, right? And it wasn't, they couldn't foreclose, but they could do a lot of other stuff to you, like kick out the sponsors and whatnot. So when you started seeing the pref equity coming in, before the LPs, right? That is also a huge sign that the end is near. Right.
Yeah. What I've learned about this real estate cycle is it's always the debt that blows up or kills people. It's always the debt. It's
not just the debt, but I want to also talk about pref equity for a minute, because why is there suddenly all this pref equity available?
It's a way to step in front of the line.
Yes. It's because the pref, and here's the funny thing. We call them pref lenders, right? That's a giveaway, right? They're not pref investors. They're pref lenders. So, because the pref is saying, we know the crash is coming.
Yeah.
We want to get in here and be ahead of the LPs because they're going to bear the first dollar of loss. And then maybe we can actually take over. We can cram them down, force them out. And so there are a lot of predatory pref lenders that come in specifically with the idea that this is why they're coming in, because they want to squeeze out the sponsor, squeeze out the LPs. So the very existence of pref equity in large amounts is a sign that there are now people who are investing, looking to the other side of the peak. Right?
Yep. The vultures are out.
The vultures are out. Right. So when you see that, this is a great time to sell. Right. Sell to one of those groups with pref equity. Right. You're going to get top dollar, but don't wait, because this is now, the clock is really ticking at this point. So these are the signs that will alert you to the top of the market, next time we're there. But that's not going to be here for like 13 more years. So like, write this down someplace so you remember it.
Don't forget.
Yeah.
It'll happen again.
It will happen again.
You're amazing. I can't believe you and I have been talking for over 5 years.
Well,
It was
yeah.
fun to go back in the time capsule and realize that we called this October 8th of 2020. You're amazing, man. Take care.
Thank you. You too.